All right, let's dig into AAON's second quarter earnings. And wow, to put it mildly, this was a brutal quarter. The market absolutely punished the stock, so we've got to take a closer look to figure out exactly what went wrong. Let's get right into it. So, right off the bat, the headline numbers were not pretty. Non-GAAP earnings per share came in at just 22 cents. I mean, that's a shocking 29% miss compared to what analysts were expecting. And if you were hoping the top line would offer some relief, well, you're not going to find it there either. Revenue was $311.6 million, falling more than 6% short of forecasts. As you can imagine, the market's reaction was swift, and it was harsh. In pre-market trading, we saw the stock get absolutely hammered, plunging as much as 23% as this news hit the wires. So the big question is, what on earth caused this kind of massive breakdown? Is demand for their products just drying up, or is there something else going on here? Well, to their credit, management didn't try to hide or sugarcoat it. The CEO came right out and pointed the finger squarely at themselves. It was a self-inflicted wound, a seriously botched rollout of a new ERP system. So let's be super clear. This wasn't a market problem. This was an internal execution failure, plain and simple. And here's how that one mistake created a disastrous domino effect. It all started on April 1st, kind of fitting, actually, when the new system went live at their Longview plant. It immediately just crippled the production of critical coils. Now, for a manufacturing company, this is your absolute worst nightmare, because the main Tulsa plant needs those parts from Longview. It was basically starved, and its own production ground to a halt. The end result? A total collapse in company-wide gross margins, which cratered by 950 basis points. That's a massive 9.5 percentage point drop. Okay, and this is a really, really important but. Here's where the story gets a lot more interesting. You have to separate this execution disaster from the actual health of their underlying business. Because as it turns out, demand is the complete opposite of the problem here. It's really a tale of two companies right now. On one hand, you've got the core AAON brand, which got totally hobbled by that ERP issue. Sales there were down almost 21%. But then you look at their BASX brand. This is the part of the business that serves the booming data center market, and it was just on fire. Sales there exploded, up 90% year over year. And get this, data center sales specifically were up a mind-blowing 127%. They are plugged right into one of the hottest growth trends on the planet. And the proof of that incredible demand is right in the backlog. It's now sitting at a whopping $1.12 billion. That is a 72% jump from this time last year. So the story is crystal clear. The orders are pouring in. They couldn't build and ship the product this quarter. Now, of course, a fumble this big is going to have ripple effects for the rest of the year. Management really had no choice but to take a hatchet to their full-year guidance. So they took their sales growth forecast all the way down from the mid to high teens to the low teens. And that gross margin target slashed from around 33%. Now they're hoping for something in the range of 28 to 29%. What this tells you is that management is building in a huge buffer. They know this ERP recovery isn't going to be a quick fix. All right, so let's put it all together. What does this all mean for the stock going forward, and what should you be watching for on the next earnings call? When you boil it all down, the narrative here is actually pretty straightforward. You've got this one-time disastrous execution stumble that is completely masking the fact that demand is incredibly strong and even accelerating, especially with that data center tailwind. So how do you play this? What's the trade? For us, it's all about show me, don't tell me from here on out. Over the next couple of quarters, we need to see a few key things to get confident again. First, those gross margins have to start climbing back up toward the low 30s. Second, we need clear confirmation that production at Longview and Tulsa is getting back to normal. Third, that massive backlog needs to start turning into actual, real sales. And finally, let's see some more of those big data center wins for the BASX brand to keep that momentum going. Which brings us to our final take. Look, the demand story here is fantastic, there's no doubt about it. But the path back from this mess is absolutely loaded with execution risk. Because of that, we are assigning a rating of underperform. We're staying on the sidelines until management can prove with hard numbers, not just words, that this whole ERP crisis is truly in the rearview mirror.
This is not financial advice.